and welcome to Indianomics. The hot topic of the day, of the week, of the month, of the year, quite clearly is banking industry and its challenges and opportunities. Never before have 21 licenses been given in a period of 6 months. Clearly, in the next 18 months, the terrain of banking is all set to change, and it is coming at a time when the banking industry is still passing through some of the challenges of the 2008 to 2013 period, the period which saw a lot of generation of challenged assets, default assets or bad loans. How will it negotiate? How will legacy banks negotiate this? And how will the stronger banks negotiate this? You can't get a better idea of how the banking industry will pan out from someone other than Chanda Kochhar, the head of ICICI Bank. Well, Chanda, thank you very much for joining us. Well, first up, let me start with the good news. We've got this slew of rate cuts from the Reserve Bank. Is life a little easier, especially because you are a big retail bank?
I would say that any cut in rate helps overall because it reduces the interest burden, it enables more and more retail customers to take more loans, whether for homes or bigger homes and so on. It eases the pressure on the existing projects when it's corporate. So I think overall, of course, it makes a positive difference. It's just that it's too early, to expect a sudden increase in demand on account of reduction in interest rates as yet.
I think your cost of money, one-year rate is now at 7.5, a fixed deposit rate. 7.5 is almost 200 basis points lower than the kind of bulk and FD rates one saw 2 years ago. Doesn't that give you all a much better margin to play with?
Let me, put this whole thing in perspective, Latha. One is that when one talks of repo rates, the cost of funds for the banks depends on the cost of deposits.
Yes, of course.
The deposits, almost 35% of your funding comes from current and savings accounts. There the rates have not changed at all. You see high interest rate ads every day. There the rates have not come down.
But that is coming to you at 2%, 3%.
No, it's not coming at, even that is 4%. But I'm saying those rates have not changed when one compares the rates. In the rest of the 65%, yes, the wholesale deposits, I think in the last 1 year or so, cost has come down by 150 basis points. Retail deposits by about 110 basis points. So if you weight all that, I think the cost of funds for a bank would have gone down by about 75 basis points or so. And you've seen the banks transmitting back about 65 to 70 basis points. So I think a large part of the transmission has happened.
Recently, when you cut the base rate, you all have cut your deposit rates. So should I assume that at the end of this quarter or early next quarter, you will be able to cut lending rates a little more?
Yes, I think the lending rates would come down even further, irrespective of the repo rate change, because the deposit rates have continued to go down, and as that impact gets translated, and it will get translated more and more in the cost of funds, base rates will come down even more.
Are small savings such a big challenge? I mean, if they come down, will your deposits become really that much more attractive?
I think it's actually the other way around. That is, if the deposit rates continue to come down continuously and the small savings rates do not change, then people would want to divert some amount of their savings to small savings. So, in order for deposits to continue to remain as attractive as any other financial savings, the rates have to move in tandem.
Okay. Well, you spoke about, there was a reason why I asked you about your cost of money and whether it's comfortable, because you said that 35% is current and savings account that don't change. Will that cushion be available 18 months down the line when the payment banks come in? Two banks that started off, Kotak and Yes, would continue to pay, for savings rate 6%, 7%. The new guys will also perhaps have to do that. Would you see a challenge?
The way we look at it is that whatever the new banks can do, actually the incumbent banks can anyway do. So,
that's those products.
I'm coming to that. So I think, but that's imperative, and that is what we have to continue to do. As far as pricing policies are concerned and practices are concerned, it's quite possible that new entrants, especially when they start from a smaller base, there could be some disruptive pricing. I think we'll have to watch how disruptive, if at all, they are. How long can disruptive pricing mechanisms be sustained, even if they are disruptive? So I think it's too early to think that things will just get disrupted.
No, you know, the trouble is, or maybe the reason for fearing disruption is they are coming with deep pockets. I mean, look at the groups that have got licenses, Birla's, Reliance, as well, you know, Paytm. They are companies with very huge private equity backing. So their ability to incur losses could be longer. So you may see a 6% interest rate by several payment banks for a longish bit. Do you see that?
As I said, it's quite possible, but you know, even if entrants come with deep pockets, the incumbent banks are also not small. We also have large pockets, but I don't think the intention here is to just follow disruptive practices for the sake of following disruptive practices. Finally, everybody would want to create a sustainable banking model, and that's where it would sit. So, you know, while I would say that whenever new entrants come in, you know, the pricing, the practices, etc., will have to be watched. I don't think one can wish those away. But at the same time, I don't think that you know, existing models will get destroyed.
Is that one of the features you expect, say, 24 months down the line, that current and savings account kitty for all the big banks could be maybe 30%, maybe 25% rather than the current 40%?
Well, you know, one is, even if you look at the industry as a whole, in any case, in the last 2 years, the current and savings account proportion has come down. So there's no doubt about it. People don't keep that much idle money. As money gets more and more expensive, people don't keep that much idle money. So that proportion has come down. But where does the efficiency of the banks lie? For banks like us, we have during this period actually increased our CASA deposits. So, and that happens because you create that more sticky relationship with your consumer, and the consumer looks at you not just for the rate of saving on your savings deposit, the rate of interest on your savings deposit, but the entire gamut of services and the experience that the customer has with you.
Would you want to tie up with the payment bank? You have Fino, I know, but what is Idea's reach? I mean, what's Airtel's reach? Would you want to tie up with...
So we continue to keep tying up, actually. You know, even before the payments bank concept was there or not there, you know, we were tying up. And I think I always believe that we have to be open for any kind of tie-ups that add value. At the same time, even before waiting for those to happen, you know, you continue to offer your products. When we launched the product called Pockets, it is much more than a payments bank, actually. So, you know, we should do what we can irrespective of the tie-ups, and I think we should be open to tying up with various entities in various fields.
It's going to be a kind of challenge which the legacy banks have not faced so far, because these are guys with a lot of clout, a lot of money power.
I would more put it like this, that in this ever-changing world, in any case, you know, your business models need to keep getting redefined all the time, and that's.
But the industry will see inorganic moves. You think somebody will be buying up a payment bank license, or payment banks buy one another?
Yes, of course.
You expect that to happen as soon as a year or 2 years?
Yeah, maybe 2 years. Of course, a year is too short a period.
Barely launched.
Too short.
What about the small banks? Even some of them are, one of them at least is an NBFC, the others are microfinance institutions. Will they make it difficult for the legacy banks in the priority sector area? I mean, is it, for instance, now you give loans to microfinance institutions and that is counted as priority sector lending. Now, some of these will not now come in your category because they will take their own deposits. So will meeting priority sector commitments become difficult?
So I think every type of player that comes in will have their own kind of niche advantages. So, you know, the microfinance institutions, for instance, have this big advantage of starting with a customer base, which itself is very large. And yes, therefore, they have direct access to the priority sector kind of lending. But at the same time, there are possibilities of working together with them as well, because their ability to originate priority sector advances would actually still be far higher than their requirement for priority sector funds. So it's not
priority
as if
sector certificates could become a reality, you think?
Yeah, so that or tie-ups for origination and then passing them on to the banks, I think all these exist. So it's not as if this source of origination of priority sector will disappear entirely.
Okay, well, that much was about payment banks, but Chanda, I have a lot of questions for you on asset quality. All that coming up with the Managing Director of ICICI Bank in just a minute after this break.